What is going on, everybody? So today we're in a brand new video. So today we're going to be covering a stock that is pretty much one of the stocks that is in the top 4. And if you're just going into investing, then Meta is obviously Meta, Google, Apple, or all of those stocks that you have to analyze to sort of start your investing journey. And that's exactly what we're going to do. So Meta stock, it keeps on going up. In the last month, we're up about 11%. We obviously hit new time highs even after the crash. And just a little bit of as a spoiler alert, in this video, what we're going to do, all right, we're going to go into everything. We're going to go balance sheet. We're going to talk PE ratios. We're going to do a discounted free cash flow model. We're going to go over the growth potential there is. And then we're going to see how they make money exactly in detail. So that's what we're going to do. Also, a little bit of a spoiler, I bought some shares. So that will already tell you that I think that it's a good stock to buy. I bought around $1,000 of this stock. So Facebook started off as just being Facebook, right? Started off just being Facebook, then it acquired Instagram, WhatsApp, then it has Facebook Messenger, Instagram DMs, Threads, and more and more and more. And so Facebook sort of started as just being Facebook. And then they just now have a portfolio of companies that generates ads every single second or every single day. So let's look how they make money, right? In fiscal 2023, advertising revenue accounted for 97.8% of Meta's total revenue. On the other hand, Reality Labs, which is their AI, their MetaQuest revenue, makes up only a small portion of Meta's total revenue, and that was only about 1.4%. Right. So now that we know that, let's look a little bit more in depth on how the entire sort of earning graph looks like. They've got Facebook, they've got Instagram, WhatsApp, Messenger. So advertising, they made 31.5 billion in Q2. Obviously with their family of apps. Reality Labs only took literally 0.3 billion, and it actually goes back. We went back 39%, but anyway, it's just a big part. And what's very interesting with this company is that they have a huge profit margin. They have an 81% margin and operating margin of 29%. Of 29%, and a net profit margin of 24%. All right, now let's take a look at the revenue. Let me scale this back. Right, now let's take a look at the revenue, yeah? So, obviously, the reason, so as you can see, the reason why the stock collapsed really went down to about a P ratio of 10 was because of this. Because this was the first time where they actually went back in revenue. But then, all of a sudden, they started growing back again about 15-20% per year. And the reason for why they had this little flat out is, first of all, because of TikTok competitor, but the biggest reason for that is one of the biggest advantages that Meta has is that it's able to quickly adapt to the changing environment and minimize its losses. Now comes the important thing. Even though the company suffered from Apple's decision to change its privacy policy a couple of years ago, so Apple changed the policy for collecting cookies, which actually hurt them because they work on advertising. So that's why that happened. But which affected the way advertising algorithm works. But Meta was able to quickly find new solutions to remain the top advertiser. So basically, they made it happen, and they made it happen well. So now we're back on an uptrend, right? So everything's good. Nook. Right, so let's look at the revenue now. Okay, so we've got about 149 billion in revenue, okay? But what is really, really important with this company, and that you've got to look at, is their net profit margin. Net profit margin of 34% this quarter is absolutely tremendous. Give me one business that's as good as give me one business that generates as much of a net profit margin as Facebook. It's a real cash cow. You know what I mean? Right, now let's look at, because of these 15% growth rates, the question is the company overvalued? And is it just have they just been growing a little bit and now it's the end of it? Well, no. We've got predictions here. I took the 1000X stocks by Jeremy Lefebvre. It's a very good thing. Good predictions, and predictions that I would have made myself as well. 2024, they're going to grow about 20%. In 2025, they're about to grow 13.3%. So, I mean, they're growing. And even if we look at here right now, we're even expecting with 12% growth in the year 2028. Now, the question is it a cheap stock? It is. We've got a forward PE of 25.58. It is a really cheap stock. We're looking at a stock that is really cheap for a company that grows like 15%. 25 is not acceptable. They should have a much bigger PE. Granted, they're just an advertising company, which isn't the best, but still. So then what I actually went ahead and did is I went over basically discounted cash flow analysis, which I made, and then sort of took the results from somebody on Seeking Alpha, an investor. So basically, I'm going to spare all of this. Obviously, work through the discounted cash flow model by yourself. But so basically, we have this right here, and then basically at the end of the equation. So obviously, you've got to do this projection by yourself, because I think they're going to be able to grow 12%. Do you? Maybe not. So do your own research, yeah? And that basically means that we have an implied share price of 533, which means that that's not that good. But what I'm saying to a lot of people is that the discounted free cash flow models only work with boring companies. Yeah, I'm gonna say it, man. Sue me. With boring companies. Facebook is not a boring company. For stocks growing 15%, advertising company, I just don't think that it works this good for new sort of growing companies. Now, obviously I told you how they're gonna probably continue to grow at least 12-13% over the next 10 years even, and I told you that their PE ratio is very low. I'm going to try and tell you also what's the growth potential here, and a bit of context as to why sort of this is deserved. Why basically a bit of context as to why like 15% over the next 5 years revenue growth is deserved. Well, here. This is the overall in ad spending over projected from 2024 to 2028, and as you can see, it's expected to grow from 740 billion to basically 1 trillion. So it's about to grow. I mean, it is a growing market, as we saw. It's a company which grows 15%. It's a company which is extremely cheap with a PE ratio of 20. I bought the stock, and I think it's going to be even. I think every single stock right now is a good buy. Why? Because we're going to cut on interest rates. That means there's more stimulating the economy, more spending. More people are going to be able to take the money and pay it for spending. So overall, I think it's a very good stock to buy, short term and long term. Obviously, that is not financial advice. You have to understand it, man. It's not financial advice. Do what you want with your money, but I'm just trying to give you the knowledge that you need. Cheers.